Hey there, everyone. Happy Monday, March the 5th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an absolutely stunningly beautiful Redmond, Washington. We got highs in the 60s, not a cloud in the sky. Trees are green, sky is blue. We'll take it. Pretty awesome. I mentioned on the show, I believe, on Friday, we're going to the Sounders game. They had a dramatic victory over St. Louis City FC at Lumen Field here in Seattle. 4-1 was the final. Awesome evening for the Keller family. Enjoyed it a great deal. Hope you guys had a great weekend, and welcome back to the show here on Monday. We are live streaming, by the way, on Facebook, LinkedIn, YouTube, and X. And I appreciate you so much tuning in on any of those platforms. Those of you that are here live, please feel free to drop questions as we go through the show today. At the end, we'll try to take a question or two before the end of the episode. Anything we don't get to, we'll put in the mailbag. We have a fun mailbag episode every Friday. Last Friday's was a really good one. Some really thoughtful questions from all you guys. I appreciate them so much. I do see some initial comments. I'm guessing referring to Warren Buffett's sudden but very anticipated departure from Berkshire Hathaway. Don't worry, I'm not planning on retiring anytime soon, but I'm not 94 yet. Also, I got a little more of a runway than that, hopefully. With that in mind, let's get to our market recap and see how things have played out today. So kind of a really, really interesting day. This day had kind of three parts. The first part was in the first 30 minutes of trading where we opened lower, right? So we gapped down at the open to open at 56.40-ish in the first 10 minutes or so. The second part of the day was from around 9:45 a.m. to about 2:45 p.m. In Eastern time, which is when the market sort of chipped away at that initial sell-off. But look what happened in the last hour and 15 minutes of trading. A complete reversal to the downside. Plenty of headline risk happening here. We're in the last big week of earnings, so some earnings to talk about, but not a ton. This was more about the market just fluctuating as expectations kind of ebb and flow. But it was a lower open, a stronger upswing through the course of the day, not enough to regain Friday's close noticeably. And then today we went lower. What's interesting about that, this is the first down day we've had for the S&P in a while. I'll show you the chart about that, what that actually looks like. It tells you a lot about the just incredible rally we've had off the early April lows. At this point, it's all about the 200-day moving average, which we are very, very close to for both the S&P and the NASDAQ. I think the question for this week, will we have enough upside momentum, enough gas left in the tank to power above the 200-day moving average and attempt to get back to previous all-time highs? I would humbly suggest unlikely. I think the more likely scenario is we have a pullback from the 200. It seems like a pretty I don't want to say straightforward. I don't want to ever suggest this is easy because it's been tough seeing the volatility and seeing the movements, but the severity of the rally has put a lot of breadth indicators into overheated territory. That, as we approach previous highs, suggests to me we probably get a tactical pullback here. We'll see. So maybe today was the beginning of that here in the last hour, but for the record, that was enough to push the S&P down about 0.6% to close at 5650. The NASDAQ composite down 0.7% there, and we can see the mid-cap index, the best of the bad, only down about 0.25%. So to be clear, this is not a big down day. Nothing really scary about today. Just the last hour of trading rotated lower, and it was enough. It looked like the S&P was going to have yet another up close. I mean, it looked really like that until about 2:45 p.m. And in the last hour really rotated things downward very, very quickly. The VIX did actually move higher about a full point, still sort of in the low mid-20s, 20, just below 24. So VIX sort of in medium volatility range. If low volatility is below 20 and high volatility is above 30, 20 to 30 means uncomfortable and not low and not high, but just kind of choppy, sloppy sideways in the middle here. Other asset classes, let's continue on looking at the fixed income markets. We can see the Treasury yield curve basically drifted higher today. The 10-year point a little bit to the upside around 434 at the close. The long bond yield's above 4.8%. 5-year point just below 395. So bond prices moved lower today. The TLT was down about 0.6%. Dollar index slightly lower from Friday. No big real change there. A lot of movement in the commodity space. I think one of the big stories today from a technical perspective. Gold bouncing back higher. Gold's been pulling back here, right? I mean, of one of the concerning things I will tell you, besides the fact that the S&P rolled over going into the close, the fact that gold just sort of ripped higher through the course of the day here, opened higher, closed higher. The GLD was up about 3%. That on its surface is not necessarily bad for stocks, but it certainly feels like the trend we've been observing since early April to early May has been gold prices, which were remarkably strong, pulling back, stock prices, which were remarkably weak, bouncing higher. Do we get a mean reversion away from this short-term rally we've had, right? Where stocks rally, did they roll over off the 200-day moving average? Gold, which has pulled back, are we making another higher low? And now we're sort of pushing back to retest the highs. I think there's a decent chance that that's how things played out. For today, stocks weaker, gold and silver, precious metals higher. Copper was higher as well. The rest of the commodity space generally weaker. Crude oil prices had a rough day. Energy, came out a bunch of earnings at the end of last week. Now into this week, crude oil prices opening and moving lower yet again. Cryptocurrencies looked interesting over the weekend. Bitcoin actually got up to around 98,000 before retracing, and during the equity session here, it's more in the 94 to 95,000 dollar range. Bitcoin's currently flat for the last 12 hours or so. Currently around 94,500. Ether prices holding steady just above 1,800. And that's down from hitting 1870 yesterday on Sunday's session here. You can see the rest of the cryptocurrencies tracked there on the stock charts platform, basically flat for the day, kind of mixed, I guess, is what I would say. Looking at the sector breadth, not great. Only two of the S&P sectors were in the green today. Now, earlier, it's been kind of like this, but it certainly felt like we might start to see more of these turn green as the market rotated higher through the course of the day. But communication services is your best performer, only up about 0.25% today. Industrials and consumer staples were basically flat for the day. And then it kind of gets bad from there. Energy, the worst, down 1.8%. And again, from a technical perspective, I'm just not a lot to like in the energy sector, I would say at this point, particularly in the big names with the biggest weights in the XLE. They're just in primary downtrend still. And so I get interested in charts like that when they stop going down, when they show signs of stability. We've seen little fits and spurts of that, but not enough. There's a little too much retracement happening there. Consumer discretionary second from the bottom, down 1.1%. Tesla and Amazon both having pretty rough days today, as we'll see in a moment at the on the market carpet. Materials third from the lows, third from the bottom, around 0.7% to the downside. Just to keep you updated on the market trend model, as of Friday's close, we're sort of in this short-term bullish, medium-term bearish, long-term bullish configuration. And what that basically means is the long-term, that secular trend is still good. My model is basically saying we're still in a valid uptrend over the very long-term time frame off of the October 2022 lows. The medium-term model being negative means despite the short-term rally that we've seen, which agreed has been remarkably impressive off of the lows, it's still not enough to turn the medium-term model bullish. Now, if you're looking at this and you're thinking, Dave, what the heck? S&P's gone from the April low to now where we're at now. How can that medium-term model still be bearish when we've had this kind of rally? It's all about volatility, right? So in an elevated volatility environment, the moves downwards are aggressive. The moves back up are aggressive. And what I've often said is that bear market rallies within distribution phases have the three S's: sudden, severe, and seductive, right? Sudden, they kind of come out of nowhere, right? We're making a new low in early April, and all of a sudden, boom, we're at a V bottom. That's sudden. Severe means it's not just a sudden stop and then we chop around. It's usually this big rally because FOMO just lights up and everyone's afraid they're going to miss it, and we all buy very, very quickly. And they're seductive because what often happens, some of the biggest moves you're going to have are in distribution phases. And so what the model is telling me is basically think of this as still a rally within a distribution phase on the cyclical time frame. At some point, this turns bullish, and I'll have to say it's no longer a distribution phase. It's clearly an accumulation phase. I just don't think it's clear yet. And the problem is now we've rallied up to the 200-day, kind of the spot where not just me, but many people are keying in on expected resistance. I think that's what probably makes it happen more than anything, but we'll see. Looking at the breadth, breadth has been pretty positive here in the last couple of weeks, as we've reported on many times. We had a Zweig breadth thrust recently, which does not happen often, but represents very weak breadth that turns into very positive breadth in a very short-term window. That happened in the month of April. Today, however, the breadth more negative, about a 2-to-1 ratio, stocks down versus up for the S&P 500, for mid caps, for the NASDAQ, for the New York Composite Index as well. So to start off the week, we've got a weaker breadth condition. Definitely not a bullish sign if you see these kind of numbers through the course of this week. That would certainly, for the S&P and the NASDAQ to power above their 200-day, you most likely need to see much better breadth conditions than what we're seeing on this particular trading day. Let's look at the big dogs, the major Magnificent Seven and friends, the mega cap growth stocks. Only 3 of these in the green today, not by much. Meta and Microsoft, which are 2 earnings names last week, certainly have probably the most improved award. If I was throwing awards around for this group of growth stocks, those 2 would probably be on there. Meta up 0.4%, Microsoft up 0.2%, Alphabet basically flat from Friday's close. The ones on the downside are the ones that are concerning, though. Apple down 3.2%. It seems like out of this basket of stocks, the one most vulnerable to the whole tariff thing is Apple, down over 3% again. Tesla having all sorts of brand issues and everything, down about 2.4% today. Netflix, which has been arguably the best of these charts, coming off of a new all-time high last week, down 2%, along with Amazon down 2%. So again, I mean, the charts like Netflix are still very good charts, but you know, for the market to go meaningfully higher beyond what we've seen so far, I think it has to involve these names looking a lot better than what we saw today. This sort of pullback sort of distribution is what gives me more confidence that this is a point where you start selling into strength as opposed to buying the strength that we've seen here in the last couple weeks. All right, let's go to the market carpet. This is a heat map style visualization. As a reminder, the beauty of this one is that it allows us to go macro to micro, right? To look at the big picture, sort of the overall look and feel of the carpet, of the quilt here. And then it allows us to drill down and look at particular themes, particular stocks, find outliers. And I love this kind of visualization that allows you to do a little bit of both. As a reminder, I can see questions coming in on Facebook, LinkedIn, YouTube, and X. I'm getting questions on a number of those platforms, and I appreciate you guys throwing questions in as we go. We'll grab a question or two here a little later after the chart review, and anything we don't get to, we'll put it in the chart this mailbag. And if you missed Friday's show, it was actually a really fun one, going through some great questions from you guys here last week. All right, looking at the market carpet. I mean, I don't know about you, but this is not a warm and fuzzy kind of everything's good kind of market carpet. Some of the days here in recent weeks, we've had a lot of green. Seattle Sounders colors kind of green. Now it's not seeing a lot of rave green. I'm seeing a lot more brick red. I don't know what team that would be. Chicago Fire. I don't know my MLS teams that well, I guess, outside of the Northwest, but not our team, and not good. And I will say what immediately jumps out are some of these names that are down pretty significantly, right? Apple down over 3%. That's been an ongoing kind of issue, certainly as other growth stocks have attempted to recover. Apple probably one of the weaker from a technical perspective. Berkshire obviously moving lower after Warren Buffett's. I mean, I've heard it called a surprise announcement. I don't know how surprised we should be at this point. I mean, it had to happen at some point, and we're running out of years for it to happen, I guess. I mean, I hope Warren lives for many, many years, but certainly seems like he's toward the later innings of his illustrious career. So it was bound to happen, but certainly creates some disruption in one of the most stable companies in the history of the equity market. So down about 5% today. Amazon and Tesla right in the middle, down about 2+%. Also random other ones like Starbucks, which was an earnings name last week. Netflix, I mean, not a horrible day, right? It was down 2%, but the problem there is Netflix has been, without a doubt, the best chart within that group of mega cap growth stocks. So that's a theme to pay attention to. Other random things as I'm stream of consciousness style ripping across this market carpet. Airlines, right? So Delta Airlines actually managing to have an up day, up about 3% today. And others up as well. I mean, United Airlines up slightly, 1+%, but on a day when there was this big distribution going into the close, names that actually managed to finish positive tells you there might be something there, right? Some other thing happening on there. Airlines have been interesting charts. I mean, really starting to bounce off of those lows, had been underperforming for a while, but if they hold up, I mean, all of a sudden that's a very unique opportunity for stocks bouncing off of the lows and maybe improving on a relative basis as well. Boy, the energy sector continuing to not be a great place to be. You know, I'm remembering my interview a couple weeks ago on the Market Misbehavior podcast, and I was talking with, who was that I was just talking with? Rob Thummel. Rob Thummel from Tortoise Capital in Kansas City. Rob's awesome. A money manager, really focuses on the energy space, knows the space well. And we quickly, you know, we were talking about energy, and I'm thinking we'll talk about crude oil, Exxon, Chevron, ConocoPhillips, Halliburton kind of stocks. We were talking about energy infrastructure. We were talking about natural gas. He was making the case that it's the other stuff, not the big oil companies, that are probably in the better position here for now. That appears to be pretty good thoughts there, because that's where you're seeing some continued strength, things like pipelines and others, higher yielding parts of the energy sector. So make sure you listen back to that interview if you haven't done so yet. Other than that, kind of a flat, choppy day, right? I mean, not a real big conviction day. Benchmarks moved lower. That's driven by the fact that some of these big names struggled, but the average stock kind of an unchanged, slightly lower type of vibe. A lot of neutral color on here. And again, I mean, this is at least a bit of a pause as we prepare, as we address the 200-day moving average. Boy, this is a key moment for sure. All right, we're going to continue on here in a moment, talking about the charts that I have saved, the daily chart of the S&P and elsewhere. I do want to remind you, by the way, Seeking Alpha has a promotion going on. They've been a great partner to Market Misbehavior, and I appreciate the partnership very much. They have a spring sale going right now. If you use the QR code on your screen, or go to marketmisbehavior.com/Seeking Alpha, you can get more information on their spring sale, $30 off their Seeking Alpha Premium, and they're throwing in the next Alpha Pick, which is their quantitative team using the quant model, hand selecting names that they think are in good setups. I'd encourage you to check that out, and if it's something you enjoy and you follow through with, you get a better deal. Helps me keep making Market Misbehavior awesome. Seems like a win-win to me. So scan the QR code if you want more information, or go to marketmisbehavior.com/Seeking Alpha for more info on their spring sale. All right, let's look at some charts together, shall we? Here's the daily chart of the S&P 500, rallying obviously incredibly well from the early April low. We have the secondary low here around 5,100. Turns out that was indeed a higher low, and on this tactical time frame, undeniably strength coming off of the last 4 weeks for sure. We've broken above trendline resistance. We broke above 5,500. All of that, to me, think of it as a stoplight. I think below 5,500, the light is red. I think between 5,500 and 5,750 to 5,800, we'll call that yellow light. Above 5,800, it's a green light. And at that point, we get to 5,800, we push above there. I think you have to be, riding the S&P higher at that point. And it may stall out at any moment, but there's enough strength there and enough sustained strength. And that's the concern up until now. We've had big volatile swings on the downside and on the upside. And for now, it's all about, we've had this run. Now we've now had this move. We've now retraced all the way to where we were when the tariffs were actually announced, right? This was the day the tariffs came out. This was the next day where we gapped down, and then the day after where we gapped down even further. And in about 2 sessions, we'd cut 500 points off the S&P 500. We've now fully 100% retraced as of Friday back to that close, the day that the tariffs were announced. So what does that mean? What does that mean? That means we're back to flat. We're back to level. Now, what propels the market higher, right? So, I mean, you have to think about optimism that comes beyond what we've seen so far. From a technical perspective, I would say there's a big challenge in overhead resistance. This is what we call a supply zone, an area where selling has happened before, an area where you anticipate potential selling because of resistance levels. We're right at that point. The RSI is right at 60. If this is more of a cyclical bear phase, which I've been labeling it as such, can't go much higher than this momentum wise, or else I don't think you can label that a bearish momentum characteristic. But for now, you still can't, because 60 is kind of the upper end of that range. So we're right at that point where this is a bear market rally that stalls out and we pull back, or we power through the 200-day. And I think I see that as the less likely, but certainly a possible scenario. if I were you and you've been caught off guard by this rally, I would be thinking, at what point do we start to layer in? We're in the yellow light, which means in my own portfolio, I've taken some more aggressive defensive bets off, certainly, and have started to get more neutral positioning and added on a little bit of risk, but I'm still pretty risk off relative to what I've been like in 2024, riding this consistent uptrend. Nowhere near that kind of allocation. It's still more defensively minded. And I think that's fair given the rally off of the lows, given the fact that we're sort of in a neutral territory. We get above 5,800 though, and I think you have to kind of be going all in and being more, playing further optimism. But I think that's a big ask for this market to do so without at least some sort of pullback. I think the more likely scenario, what I would guess, given the severity of the sell-off, the FOMO-led rally off of those lows, but with all of the macro issues that are still very much there. I mean, even today, you've got companies, like lowering guidance or removing guidance. You've got Palantir, pushing their guidance higher, but that's a rarity these days. It's more, erasing their forward-looking guidance and saying we got to wait and see, and we'll let you know when we have a better idea of what to expect. That doesn't imply optimism for me. So I think a more likely scenario, we get a tactical pullback and we'll be down here around 5,500. And then we have to have a big debate as to where do we, what kind of breakdown makes this bearish again? Do we hold support? I think that's probably what happens in May. It's a guess though. We'll see. All right. Looking at candles, I just want to highlight today was a down close. And I wanted to point that out because that hasn't happened in a while. There's a color coding system on the stock charts platform. I don't know if you know this, but if you bring up like a random stock, and I know many of you are stock charts users, you don't have to be, and certainly that's not a requirement for watching the show, of course. You're welcome to use whatever charting platform helps you answer the questions you're asking. But if you do, there is a way to color code, these color schemes that you have here allow you to color code up days and down days by a particular color. So my default is I actually use bar charts and I just have them black because I learned technical analysis on Bloomberg, which was white bars on a blue background, a dark blue background. So that's still how I think of charts is not color coding bars. However, you can do that. And I think there's some benefit to it. So the color scheme that you're seeing right here, the candlesticks are still candlesticks. So open candlesticks are up closes, meaning we closed above the open. Solid candlesticks, we close below the open. And the way I remember that, by the way, if you're not a big candlestick person, is if something is solid, think of it as like it's heavy, it's sinking down in the pool. It's like a rock. So you open at the upper end of this body and you drift down to close at the lows. Think of like a rock sinking the pool. An open candle is a higher close. We close above the open. So think of it as like a balloon that's floating upwards. It's full of helium. So we open down here, we float up and close at the top. So visually solid candles, we close below the open. Open candles, we close above the open, or clear candles, I guess you'd call it. Now there's also the colors, which are red and black. And that's based on where today's close is versus yesterday's close. And I hope this is not too complex or confusing that you're losing me, or that I'm losing you, I mean. But here are here's a close below the open, close below yesterday's close, so it's a solid candle colored in red. Here we have a candle colored in black because it's higher than the previous day's close, but it's a solid candle because we closed below the open. So by looking at the candle shape and whether it's hollow or not, and looking at the color, whether it's black or red, you can answer two questions. Did we close above or below the open? And did we close above or below the previous day's close? So the fact that all of these candles are colored in black means for 1, 2, 3, 4, 5, 6, 7, 8, 9 straight sessions, we had closed above the previous day's close. And that's actually pretty impressive. It does not happen that often. I don't have the numbers in front of you to tell you how rare that is, but it just doesn't happen that much to have series of up closes almost 2 weeks straight. Today's candle in red, that's your first session in 10 that we actually closed down. That's the significance. That's the consistency of this upswing coming off of those lows. We still closed above today's open, so it was not all bad. It wasn't a big distribution day, but it just shows you how, again, how one-sided this market has been. And all of that, to me, adds up to, all right, we've had 2 straight weeks of closing higher, closing higher, closing higher, closing higher. At some point, we pull back. Like it's going to pull back. And this just seems like the place where we probably have that kind of pullback. That methodology, by the way, this chart style that I'm making, I'm going to save this one, probably refer to it randomly because I kind of like the vibe of this, combining those two different, the color scheme and also the candle pattern to sort of understand things. Look at GoDaddy. And for the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 sessions since this down candle on April 21st, the last 2 straight weeks, every day we've closed above the open. And even these gap days, right? On Friday, when we gapped down on earnings, I believe we closed higher. Today we opened higher and closed higher yet again. So even on these days after gapping lower, you're seeing buyers come in through the course of the trading day, and that tells you the strength that you have in a chart like GoDaddy, and probably gives you optimism that we hold support, and that when we gap lower, we're starting to see buyers come in. So it's an interesting sort of candle chart. I'd encourage you to tinker around with if you're so moved. Kind of finding that interesting. All right, breadth is obviously pretty important here. On the stock charts market summary page, I actually just did a video on Stock Charts TV earlier today. I don't know if it's posted yet. I think the editing team, the producing team, is kind of getting it all ready for us. But if you see, it should be out here pretty soon on Stock Charts TV's YouTube channel. But this was one of the parts of the market summary page that we looked at, which is looking at what I would call moving average breadth. Here are the major U.S. equity indexes. Here's the percent of the index members that are above their 20-day, their 50-day, their 100-day, their 200-day. Here's where we're at right now. Most stocks, almost 9 out of 10 in some cases, are above their 20-day moving average. This was down in single digits at the April low, right? So most of the indexes have regained their 20-day. About 50-50 when you compare it to their 50-day moving average, right? About half of stocks are now back above their 50-day moving average, which tells you, again, these first two columns tell you the strength on that tactical time frame. But it's the longer term breadth that is still pretty negative, right? I mean, the most optimistic are still at, almost getting to a 50-50 level. Some of these are obviously, the New York Stock Exchange, 2 out of every 3 stocks still below their 100-day moving average, still below their 200-day. So again, based on that sort of breadth analysis, the short-term breadth, extremely strong, arguably too strong in some cases. The medium-term breadth, kind of medium, average, neutral, but then the long-term breadth is still bearish. And again, if that changes, and if we see further accumulation above the 200-day and we see more and more green move from left to right, that should further validate the bull case beyond the 200-day. That tells you the S&P is going above 5,800, and maybe we retest the all-time highs here. That would only be possible, I think, if the breadth conditions continue to improve. We've gotten a lot of green on the left half, on the left column. Does that sort of continue to drift to the right? You see more and more green. The bear case from here, by the way, is watch that left column. You start to see these numbers come down from the 80s to the 70s to the 60s. That tells you the rollover from the 200-day moving average is happening, and it's real, and that's enough breadth to move things lower. So this is the chart that I used to track 2 of those 4 columns for the S&P 500. So here's the S&P on a closing basis, percent of stocks above their 200-day, as you saw in the previous table, currently around 43%. We are just over 50% of S&P members above their 50-day. That's a great sign. That holds 50%. I think we're in good shape. We break back below 50%. That's the warning sign, right? Last time that happened was back here at the end of February, basically preceding this waterfall decline. There's no guarantee that that's exactly what happens, but certainly tells you things are more negative than positive. Gold pulled back last week, and really over the last 2 weeks. We had this beautiful bearish engulfing pattern at the previous all-time high in mid-April. We then gapped lower, continued lower until last Thursday. We had this doji candle. Friday, we opened higher but closed lower. Here's today gapping back to the upside and currently above 305 going into the close. So, looking at the momentum, obviously the RSI is in a clear bullish range. Even with this recent pullback, we're still above the ascending 50-day moving average. The RSI is still holding 40 on pullbacks. This is still a primary uptrend until proven otherwise, until those conditions change. So I think gold overall, pretty encouraging. I wanted to share this with you. I'm on the board of a music school in New Hampshire, a summer music camp called the Walden School. And at some point on like a giving day, I'll try to maybe remember to tell you more about them and and encourage you to learn more about a really cool thing going on. But one of the things we talked about in terms of managing the finances and the endowment fund, which we were trying to grow, was dealing with the market volatility. And I show them a different chart, but it reminded me to show you guys this chart. This is the IBIT, which is an iShares Bitcoin Trust, right? One of the new Bitcoin ETFs, and you can see that in black. In green and in red are the S&P 500 and NASDAQ 100. This is just looking year to date from the end of December to where we're at now in early May. If you note, this shows you how Bitcoin has essentially been a leveraged equity ETF, right? In so many words. When the market's strong in January, Bitcoin, the IBIT, is up a lot more than the major equity average, right? Here's the S&P up about 4%. Here's Bitcoin up about 14%, again, using the IBIT. In the sell-off phase, right, starting in mid-January to early April, you can see that Bitcoin all of a sudden gets back to where the S&P and NASDAQ were and then undercuts it to the downside. And at the worst point, you have Bitcoin IBIT underperforming the S&P and the NASDAQ by about 4 to 5 percentage points here in early March. At the April lows, it was actually in line with the NASDAQ 100, down about 18% for the year. On the way back up, even though the S&P and the NASDAQ have recovered, IBIT has recovered even more. So if you're thinking of Bitcoin as like a way to diversify away from stocks, not the case. It actually ends up being like a leveraged ETF. It's almost like buying the TQQQ, where you get more upside in the up markets, but more downside in the down markets. I think charts like this can be helpful to help you recognize the magnitude, what the volatility actually does to your returns, and look at how these different things are related. Other asset classes have what we call low correlation, right? Or a very differentiated return profile, as I would probably write in some sort of marketing piece for a portfolio, right? Something that is doing different stuff than the S&P and the NASDAQ. Bitcoin's not it. It's basically a leverage play on the S&P. All right, let's look at some of the individual names here, and then we'll take a question or two, and we'll be done. Looking at Microsoft, gapping higher on Thursday, closing higher on Friday, closing higher again today. Chart of Microsoft has gone from incredibly underwhelming with resistance around 395 that was not breaking to all of a sudden quite encouraging. We gapped above the 200-day after earnings on Thursday of last week, and then Friday and now into today, we're continuing to drift higher. I think this is now back into a primary uptrend. That's a strong gap, and for now, we're doing a gap and run, meaning we're gapping higher, and we're continuing to move higher. The way that I approach this type of name, if you're looking at this and saying, "Oh boy, is it too late?" I hear you, because we've already gapped, right? But if you're optimistic on a Microsoft, using the gap as support is what I like to do. So I would probably, if I was taking a position today, which I don't, I would probably take the position and use 425, the swing low, that the upper end of that gap. Use the gap as support. So if that holds, then that means this gap and run thesis is right. If we fail into the gap range, that tells me, all right, it's no longer optimism coming out of the rally, and so I probably want to lighten up a little bit. It's overbought right now, which is something to certainly watch. I think that just speaks to the strength of the uptrend for now. Microsoft going higher and continuing. Meta is another one of the earnings wins from last week. Last week on earnings, we gapped above the 200-day but closed back below it. That was a dangerous sign coming after earnings. But Friday, along with Microsoft, pushed higher. Today, closing a little bit higher as well. So I would say Netflix has been sort of the lone outlier in the Magnificent Seven, showing strength while others showing weakness. And when I will say some of the Magnificent Seven names still look very underwhelming, I'm looking at you, Tesla. Others like Microsoft and Meta starting to look less bad and arguably kind of good here. I think the breakout in Meta is very encouraging. And I think as long as it holds that 200-day from above, that's a pretty decent chart. Apple, not good. Selling or rallying into a declining 50-day moving average. The RSI never gets above 60. Friday, we rotate lower. And today, it's even more selling. We're down about another 3%. I would say between Apple and Tesla, it's an arm wrestling match as to which chart is least attractive from a technical perspective, but they're both pretty bad. I don't think I grabbed the chart of Tesla, but it's not good either. Here's the chart of Amazon, similar, and then it's trading up to a declining 50-day moving average. We'll see if it's able to break above it. But again, given the choice of like an Amazon or an Apple versus a Meta or Microsoft, those latter two charts look way more constructive because of what they've done relative to moving averages, what they've done in terms of follow through and momentum, those are definitely more constructive. Palantir, one of the few companies I'm seeing actually raising their guidance for the year, talking about AI optimism and sort of being in the right place at the right time to benefit from the next wave in AI awesomeness. For now, Palantir has 100% retraced that incredible decline from a peak around 130, 125 here down to a low around 65, which is where the 200-day moving average currently resides, all the way back to retest the previous peaks. I mean, if what they are saying is true, there's certainly way more upside potential in a chart like Palantir. From a technical perspective, now that we've regained that previous peak, you have to avoid a major league double top, which means you have to break above that on stronger momentum. And that's what I'd be looking for on the chart of PLTR today. Boeing, a local Seattle company. I read something at one point that said back in, I think, the 70s, 25% of adults living in the Seattle area worked for Boeing. That's how dominant of an employer it was back in the day in Seattle. Seattle's obviously evolved quite a bit, sort of a mini Silicon Valley in a lot of ways with Microsoft and Amazon and many other companies. But back in the day, it was Boeing and engineering primarily. Here you can see Boeing from a technical perspective, obviously having a lot of issues, but bouncing off of that early April low, which ended up being basically a retest of the November 24 low. We've now made it all the way back up to those previous peaks. Now, a chart like this, I am super fine, patiently waiting for upside validation. I think we're right about there. So I think powering above these previous swing highs, which we're almost able to do, I think makes that a nice breakout. It's on breakout watch, but not quite there. Airlines, I meant to say. I said I looked at Delta and I thought about Carnival for some reason. Delta Airlines, and I have Alaska in a minute. Pretty interesting charts. I think still more to prove here. I mean, from a short-term perspective, I like the strength. We're testing the 50-day today. I think breaking above there, interesting opportunity to get back to retest the 200-day moving average. These charts got so beaten up from February to early April, but now starting to improve. The momentum is still not good enough for my general book, which is where you want to see the momentum a lot stronger. You want to see this kind of pattern, which is a breakout on stronger momentum, which tells you there's some sustainability there. That's what I'd be looking for here. Alaska, really close to a compelling chart. I think Alaska gets above like 53, which would take us above 52, which takes us above the 200-day, takes us above the recent swing highs from April. I think that's a pretty compelling uptrend chart. Bit of a bullish divergence here with lower lows in price into late April on higher lows in momentum. Airlines starting to look a little constructive there. Berkshire Hathaway, and again, I mean, it was a surprise to many because it felt like a day would never come where Warren Buffett actually talks about stepping down as chairman of Berkshire Hathaway. But the day is upon us in terms of when that is now a reality. Berkshire, obviously one of the great long-term success stories in the equity space. You look at the humble beginnings of this chart and how much the name has rallied. I mean, if you look at, these are the B shares that I use, and full disclosure, I've owned the Berkshire B shares for years. The A shares currently around over $800,000 a share going into today's trading as of last Friday. Today gapping back below there on the sell-off. The primary uptrend is still there. I mean, you have some bearish divergences going into the peak. I wouldn't imagine that there's further pullback to be happen after the significance of that news is digested by a lot of long-term fans of Warren Buffett and his methodology. For now, I'm assuming this is still a primary uptrend that I'll continue to follow and continue to own for now. But something certainly to watch, because that is the biggest weight in the XLF. It's not the banks, not JP Morgan or Goldman Sachs. It's Berkshire Hathaway, which is arguably not a financial stock. It's a conglomerate of a bunch of things, but definitely has some financials in there. And it's a weight in the XLF. So if you buy the XLF, you're getting a lot of Berkshire as part of that. All right, that's it for that. Let's get to some questions here. Let's see. Boy, a bunch of random ones. Yeah, shout out from Gorham, New Hampshire. Yeah, so the school that I'm a part of, it's actually the summer camp is held at the Dublin School in Dublin, New Hampshire, which is nearby Keene, New Hampshire, which is one of the most adorable little New Hampshire towns. Kind of like the stereotypical New Hampshire town. That's where I usually stay, and it's a beautiful area of the country, especially in the summer. All right, Pete, thanks for watching on YouTube. What do you think about PLTU leveraged ETF up 80% last month, April? I don't know what PLTU is, but I'm guessing it's like a leveraged Palantir ETF. Is that a thing? Shall we look? Yeah, there we go. A leveraged Palantir play. Yikes. So here's the here's the thing. No, not something I honestly don't think I've ever looked at this chart until right at this moment, and I'll tell you why. With leveraged ETFs, I would say I would think of it the same way I think of options, right? If you think of what you're doing with the PLTU, you're basically analyzing the chart of Palantir and saying, I'm bullish on Palantir, but I'm not just kind of bullish. I'm way more bullish. Like I want to take on even more risk and have a leveraged directional bet on Palantir. I would say for a lot of investors, that's probably too aggressive. But if you understand the risks about the structure, and I'm not going to even talk about the due diligence you would need to do on something like PLTU to just understand, make sure you understand the exposure you're actually getting, because that is a volatile play on a volatile stock. So I think that's a lot of risk. However, I don't think analyzing the chart of the PLTU is the approach that makes sense. I would say from a technical perspective, analyze the chart of PLTR, right? And that's where you should analyze things like moving averages, things like momentum, things like relative strength, any other indicators you're going to use. It should be done here. And then think of things like PLTU. Think of things like some sort of like a calendar-based options strategy or something, like a vertical spread, or just buying the stock outright. Think of all or covered calls. Those are all ways that you express your investment thesis using some tool, right? Analyzing the PLTU, there's not enough history. It's way too volatile. So I think it's just going to be a lot of noise. You analyze the underlying stock and then think of a leveraged ETF as one of the options you have, one of the ways that you can express, I'm bullish on Palantir. Okay, how do I do that in my portfolio in a way that makes sense? And that sort of way of thinking is something I learned from working with money managers. It was more, all right, here's this thing that we think is likely to happen. What are the ways that we can express that in our portfolio so that the portfolio grows if we're right and the shareholders benefit? And that could mean we use futures, options, stocks, margin account, all these different ways are different things you do to express different levels of optimism or pessimism or confidence in a particular thing happening. So I would say PLTU for me seems absolutely crazy. It feels not crazy to some of you. I wish you much luck. And I would encourage you with things like double leveraged single stock ETF exchange traded products. Make sure you do due diligence on things like the spread, the liquidity. There are a lot of exchange traded products out there that aren't liquid enough or enough that the movements really could be surprising. And I want to make sure that you cover yourself that way. Maybe one other question here. Got some great debate on some option strategies. I appreciate that. Michael, thanks for watching on YouTube. You said, David, why is the exponential 200 moving average on the S&P 500 lower than the simple? That's a great question. Let's take a look. All right, I'm going to use $SPX. I'm going to do a really basic chart. I'm going to do two moving averages. This one is a simple one. This one's an exponential one. We're going to do 200, and we're going to do 200. All right, we're going to look at a little less data just so we don't lose our minds. All right, so this is, let's see, the simple moving average is in blue. The exponential moving average is in red. And your question is, why is the exponential moving average lower than the simple? Really good question. I mean, the short answer is that's how the math works out. But the actual, like, what does it actually mean? So what's happened, and this is one of those things where this extreme volatility is affecting things very deeply, right? And indicators that had a certain look and feel in the fourth quarter of 2024 are going to have a very different look and feel in April to May of 2025 because of the severity of the sell-off and the severity of the rally. This doesn't happen often, but I'm immediately thinking back to like the COVID period, the great financial crisis, lesser bear market-y kind of pullbacks like 2015 or 2016, 2018, and like the sell-off you saw in the fourth quarter of that year, those big, severe, very volatile periods, you have to remember that moving average, like the simple 200-day moving average doesn't care how volatile it is. I mean, it really is just rolling every day, adding a new observation and rolling off another one from 200 days ago. And so at the end of the day, it's a pretty consistent kind of look and feel. And what happens is when you have a significant sell-off, the exponential moving average is more sensitive. So it's going to rotate lower way more aggressively. But the recovery hasn't been enough to move the exponential moving average back above there. When you have a big upside reversal, the exponential moving averages are usually quicker because they're more sensitive, right? They're more sensitive to more recent data. But the problem is because you've had this big puke out into the April low and then this huge rally, it's enough to really throw the benefits of the moving averages maybe off a little bit. And so usually I'm surprised, and maybe that's what your question, I'm surprised the exponential average isn't a little bit higher. Problem is we've just spent so much time below the long-term averages. We were going up for so long. Now that we're weaker, it's making both of these get dragged down, but the exponential average still being dragged down more because it's more weighted to the sell-off and it's still working off that sell-off from early April. That's the very non-math way of explaining it. The mathematical way is it uses an exponential smoothing calculation, and the way that that's weighted to the recent data, this severity is enough to keep the averages down. Even with the short-term strength, it's not enough for the 200-day exponential moving average to be that significant. If you look at shorter term moving averages, they're going to be a lot stronger because of that rally off of the lows. It's just not enough data to change the exponential averages just yet. Really great questions, by the way. That one made me think. I appreciate it so much. And folks, that'll do it for today. Thanks for joining me here on a Monday. Hope you are doing well. I think we'll have a lot to think about and talk about as we get through earnings here this week, finishing off the bulk of earnings for the S&P 500 names. The S&P and the NASDAQ testing the 200-day moving average. We'll be tracking that along with the breadth indicators and sentiment and everything else. So make sure you keep tuning in. But until the next episode, I say thank you for watching. And remember, it's always a good time to own good charts. Have a good night, folks.